Hey everyone, welcome back to Corporate Decoder. Today we're diving into a 10Q filing. Think quarterly report cards from PCB Bancorp. Get ready because it's a wild ride where numbers dance and even options become capital contributions. Yes, you read that right. This report is all about how PCB Bancorp, a bank holding company focusing on small businesses and individuals, performed in the first 3 months of 2025. Was it smooth sailing or were there some financial waves? Let's decode it together before we dive into the nitty-gritty. If you enjoy getting straight insights from company reports, make sure you're subscribed. And don't forget to join our Discord community, linked in the description below, to discuss further. First things first, this is a Form 10Q, a quarterly report filed with the Securities and Exchange Commission, or SEC, for the period ended March 31, 2025. It tells us about the company's performance for the first 3 months of the year. You'll see details on everything from their cash flow to how they're managing risk. A quick snapshot shows that as of April 30, 2025, they had over 14 million shares of common stock floating around. Alright, let's jump to the juiciest part, the financial statements. Buckle up. Alright, let's pull out some information from the consolidated balance sheets first. Cash and due from bank sits at $28.8 million. Not bad. And the total assets is $3.2 billion, which is the sum of all of what the company owns and uses to generate value. Total deposits at the end of March was $2.7 billion. That's how much money people and other institutions entrusted PCB Bancorp with. Moving into the consolidated statements of net income is up to $7.7 million. That is the final profit after all revenues and expenses have been accounted for. Also, they are calculating their basic earnings per share, how much profit is allocated to each common share, to about 0.533 cents. One thing to note on the statement of income, they had to pay out $40,000 in preferred stock dividends, meaning there are payouts that must be made to a certain class of shareholders before the common stockholders can get paid. It seems like things are going well overall, but there's always a twist, so let's look at the consolidated statements of comprehensive income. The unrealized gain during the period in available for sale securities sits at $3.21. Now the equity section of the balance sheet is looking interesting, especially for the preferred stock. You'll see some big swings there. Also, the total shareholders' equity sat at $406 million, which is the net of all the company assets after you pay all their liabilities. That's what they are truly worth. Moving on to the consolidated statements of cash flows. Cash flow coming in and out of the company looks pretty healthy, with a cash balance of $21.14 million at the end of the period. Alright, so let's jump into what's important about this filing according to management. Here's where things get a bit spicy. It turns out they had a bit of an unusual financial instrument in the mix called the option derivative, which they value at about $35 million. This comes from their emergency capital investment program with the US Treasury. Basically, it's an option to buy back stock under certain conditions. What's unusual is that they considered this capital contribution and recorded in common stock. The report dedicates significant space to how it measures fair value. They use a 3-tiered system. Think of it as gold, silver, and bronze, depending on how reliable the data is. Now, here's what's important. The option derivative mentioned earlier, which is that complex deal with the US Treasury, they classify it as level 3. That means its value is based on their own assumptions rather than concrete market data. This is something for investors to keep a close eye on, as the value could swing more wildly. Digging into the details, most of their securities are available for sale, with a nice chunk in residential mortgage-backed securities. They also don't have any individual holdings from an entity bigger than 10% of their stockholders' equity. Jumping to the fair value of financial instruments table, we get to see what the company thinks certain of their assets are worth. Loans held for sale at fair value is being calculated at a discount. Their fair value is being calculated at a discount. Their fair value is being calculated at a discount. Their fair value is being calculated at a discount. Their fair value is being calculated to be about $5 million less than their value according to the company. It's very important to keep in mind they are using models to determine the fair value, which requires their own assessment. The company used quite a bit of cash in investing activities, which makes sense as the net change in loans held for investments was about $97 million. As for financing, they saw an increase in deposits of about $98 million. That means their customers are trusting them. There were no significant adopted accounting pronouncements, but they mentioned some improvements to income tax disclosures that may be coming in future reports, not expected to have much impact. They have significant amounts of debt securities available for sale, but in general, it looks like they have more debt securities being classified as unrealized losses. Now let's talk about loans and the allowance for credit losses, something that's very important for a bank. Their total loans are $2.7 billion and the amount set aside for potential losses is about $32 million. They recorded $1.6 million for the provision for credit losses, which is management's estimate of potential credit losses. If we look at the activity in allowance for credit losses, it seems that most of the losses comes from commercial properties. Here, the interesting thing is that all of their loans individually evaluated is based on level 3 significant unobservable inputs. The business property section has quantitative information about selling costs, which average 6%. Looking at the statements of cash flow, some items can be looked at deeper. The gain on the sale of loans decreased year over year. In the same time, the originations of held for sale decreased while the proceeds from them increased. This is very insightful on the changing environment. Diving deeper, the company records ORO or other real estate owned at fair value at the time of foreclosure. Looking at the fair value by balance sheet grouping, it seems like their FHLB and other restricted stock don't have a fair value. Very interesting. Also, loans have a slightly different value than their current carrying. What's important here is they are mostly invested in longer times horizons in their securities. There's one collateral dependent business property, which again, as a loan, that is level 3. Diving deeper, now that we are talking about collateral, there is additional level of unobservable insights used for determining fair value. We are seeing an impairment on the financial assets, though it's very minor. The company used ROU right of use assets in exchange for operating lease liability, though it's worth noting the lease obligations wording here. The company has a significant amount of available unused funds from the FHLB, which is important during turbulent times. One important thing that is mentioned here is that when the company wants to exercise this option, they have to meet certain criteria and they might not be able to, which poses a risk for the company. It is good to see a decent amount of unrecognized share-based compensation that is recorded. The company uses various definitions for rating internal risks. Take note that some ratings are inadequate, which mean they are riskier. At this kind of table will help with assessing trends. They do have fair value assessments with level 3 inputs. You can also see that they use collateral to determine these prices. You can see here the non-recurring gains losses on the sales of some properties. Here's the thing with option derivatives. You use probabilities to determine the real value. Here the company states in the use of estimates section that their financial statements require the use of estimates, which could have a material effect on their financials. There's some details regarding accounting pronouncements, which includes the improvement to income tax disclosures and disaggregation of the income statements. These changes are not expected to have significant impact on the company's statements. Please keep in mind that this report contains forward-looking statements. Take all of this information with a grain of salt. Dollar J, so what's the verdict? PCB Bancorp's financial performance shows a bit of a mixed bag. On the plus side, it seems to be making progress in earning a profit and managing credit. With those rising deposits and new option derivative, the company is making a good effort to move forward. But the company does need to step it up and focus on that loan area and what caused that to increase. As the interest rate keeps changing and the economy forecasts remain uncertain, the next few quarters will be especially crucial to watch and whether they can meet those goals. That was a lot to digest. I hope you are now as prepared as possible. But again, all this information requires thinking. If you appreciate getting these deep dives into company filings, make sure to hit that like button and subscribe. Also, check out the Discord channel in the description so you can discuss it with others. Thanks for tuning into Corporate Deco, and I will see you in the next one.